Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Frac spread show, and I'm going to also cover some of the other things that we missed or that would have been highlights in the EIA show and the Econ show, just to try to piece everything together, because my family and I are finally recovering from the stomach bug that started Sunday night and continued to wreak havoc till about Wednesday, Thursday. So that was fun, as each person gradually fell and succumbed to the virus. But now here we are, and we're going to look at where some of the data sets are shaking out for completions. So it's not a surprise to see a drop from 278 to 270. I still have a little bit of reflux from that in general. So we had a drop of 8. A lot of that is weather related. You know, we had the Permian come down. The Western Gulf and the Texas, LA, Mississippi salt showed something similar. Fairly stable, but that actually dropped off, you know, just at the end of, just based on if you saw with the ice storm, the impacts that happened throughout that region, which again is something where that normally comes back pretty quickly. A lot of the drop is just because it wasn't safe for crews to get to the locations. It would have taken them too long to thaw everything out in order to make it worthwhile. So typically when you get ice storms like that make it impassable, unsafe, you'll see some of those slowdowns, and it all depends on where those slowdowns hit. But typically, once that ice clears and the roads are passable, you know, things start to get back to normal. But it's just going to delay how quickly we get back to that 290, 295 level, but not something that won't happen. It's just going to take a little bit of time, as we also had some of the smaller basins picking up a little bit of that extra capacity. Fort Worth also had a drop, which isn't all that surprising, given where we sit in the cycle in terms of where weather is, because as we've said over the last 2 weeks, weather was going to be really important. February is a tough month. If you remember, that was when Uri happened. You had that deep freeze that really created a lot of havoc on the equipment, getting to the equipment. So that was something that we did see as a potential threat to some of our views, and it hit on the rig side. When you look at rigs, you know, directional rigs came down by 7, horizontal came down by 5. It's not surprising to see those impacts, you know, so 10 oil, 2 gas. And a lot of this is weather related, a lot of shifts in terms of where some of the activity is going to take place. So we'll see those things coming all the way through, seeing all the different adjustments as they happen. You know, again, weather it's weather. Yeah, as the Paul Rudd joke goes in Forgetting Sarah Marshall. You know, weather is weather, and this is just the time of year where you get some polar vortex, you get some of that cold, and that's going to impact some of this. But again, none of it's going to be long term, just those shorter term periods. So here now, before we start going into the U.S. data, Singapore had a really sizable build, and next week we'll go deeper into that on the EIA side. You know, when we look at where we're seeing the middle distillate, we had builds across the board in terms of the total. Light distillate went back to the well above the record now, but middle distillate resid, and that's going to be really important because the EU just officially passed the cap on Russian diesel at $100. And it's not surprising to see some of that, you know, that was expected, and that price was actually expected. So a lot more of that Russian crude, and not only Russian crude now, but Russian product is going to end up in Singapore. And that's going to be the big one to watch, because that's going to reverberate through Asia, into China, and then obviously, I should say, you know, the ASEAN nations into China, and then the Middle East, in terms of where some of those flows are going to adjust, because we do expect to see builds accelerating. And that's the bigger issue, because people have asked me, what do we expect about crude pricing? Where's crude pricing going to be? And the biggest issue is going to be refined products, because we see a lot of pressure on refined product storage. We see that building. We've seen additional builds in floating storage in the Middle East. That is, again, going to create more impetus for Saudi to cut the OSPs. And then when you look at Europe, you can see gasoline had a small draw, still at ridiculously high levels on a storage level. Gas oil, big build. They're trying to bring in as much as they can prior to the February 5th deadline. And then the other areas are fairly flat, with fuel oil a bit stuck without the ability to go from Europe into the Middle East and, more importantly, into Asia. And the other issue is now more Russian products going to go that way. Trafi came out and said that they expect about 7 to 8% of the product tanker market to get moved essentially into the black market or the gray market in terms of some of the product movements. And honestly, they would know better than I would, but I think that's a very fair number if you think about where some of the movements are, how that's going to adjust, and how that's going to move product out into other markets. Now, when we look at implied gasoline demand in the U.S., you can see as for 2023, it's the average is still really low. But as we've been saying, we expected to see a bit of a rally, an increase in some of that data. In improving up into about, as we said, about 8.4 to about 8.4 million barrels a day, which is right around where we got to. And we see it leveling off and maybe coming down a bit as the weather gets a bit worse and gasoline inventory continues to build. But as you can see, the rate of change versus what's normal still remains a bit off. And that's not something that we see improving really anytime soon. It's more along the lines of the comps are going to get a bit easier. As you can see, it typically goes up, comes back down, and that's going to level things off a bit. So now when we look at implied distillate demand, you can see that the demand has improved a bit, but still very lackluster. Obviously, the cold for anybody in the Northeast is, that's going to change things a bit. It's going to get really cold, like frighteningly cold, and then get warm pretty quickly. Depending on how long that lasts is going to adjust things in general. But, that's some of those big pieces that we think we should do in, over time, and just in terms of that it'll increase, or the demand will start to improve just along, trucking has gotten a bit better. You have a bit better abilities on the demand side from not only the trucking, but also the weather piece. But the distillate inventory is not going to improve. It's only going to get worse, given now there's even more issues in terms of Russian product. That's going to push more into the international market, especially going into Asia and the Middle East, which then is going to turn around and then come back into the Atlantic basin. Miles per ton is going to go up. So cost is going to go up. Insurance is going to go up. Day rates are going to go up because you're going to have more of the fleet really utilized, and that's going to create a bigger problem on the inventory side. Be a bit lumpier, but we should see bigger draws, or at least less builds, especially as we head into when you look at pad 1. February is going to be a key month. February, it's getting pretty cold in Europe right now. It's getting obviously cold here, and it's going to be important to see how some of these shifts take place. Now, when you look at pricing, obviously pricing leveled off a bit on the gasoline side in the U.S. for the national average. You can see that diesel still remains fairly healthy. We see that holding pretty firm. We don't see too much of adjustment. As we get some builds increasing on the gasoline side, some demand coming down due to weather, that should soften some of the gasoline prices. But diesel, again, there's a lot of staying power at the pricing here just because storage is low. You're going to get a bit of that weather bump. You have a little bit of that trucking bump, and that's going to be supportive of some of that pricing. Now, when we look at demand destruction in Europe, so when you look at the energy savings has all come at a cost to Europe's economy. High gas prices, power bills have curbed demand from industries and households, which isn't surprising when you look at it just in terms of the different levels of impact. That's an issue. Now, consumption was reduced 9% in the last week of Jan compared to the 2018-2021 average, according to Germany. But they're saying that they must cut demand by at least 20% to offset loss of Russian gas. That's a really difficult number to hit with just given where the economy needs. I mean, natural gas is a huge component of power demand. It's a huge component of industrial demand. And, or does that mean you're going to have to keep, petrochemicals reduced? You're going to have to keep fertilizer production reduced. You're going to have to keep refining activity reduced. Like, these are some real issues, which is what we've been talking about when everybody was championing this huge increase in storage. It's like, great, it was great that it happened. I'm not saying it wasn't. But what was the cost of it? And that's where we see the biggest problem of, well, what comes next? How are we going to see some of this bounce? And is there a way to kind of balance some of these different pieces? And that's going to be very difficult as we go into really 2023 and not only into the shoulder season, but then into, summer demand. And if there's a hot summer, what does that mean for power demand? How quickly do we get this pulled down? Because if you remember, Germany and Europe was taking as much as they could from Russia ahead of the ban and the reduction on natural gas flows. But now, how much LNG capacity is there? Is there going to be enough floating, regasification capacity to bring it on? And there's going to be a lot to look at from that perspective. Now, just building off of what we talked about on that 20% level that Germany has, or at least the government has been talking about, this gives you an idea on that gas savings goal and how difficult it is to even hit it when you are trying to target it specifically, because you have so much industry that is still tied and so reliant on natural gas, and it's not something that's going to go away quickly. And just the other thing and we've talked about it on this show, we've talked about it on the economy show, the length of, what the government went through and went towards to trying to get the government, or I should say industries, to cut capacity. I mean, think about when they were at their peak. They had shuttered 40% of petrochemical, 60% of fertilizer production. You had 30% of industrial production offline. If you consider about economic growth, it's very difficult to achieve long-term economic growth if you have to shutter that much amount, that large piece, or I should say that much of your industrial economy to achieve that goal, because then now you're just shooting yourself in the foot to try to achieve it. So here, I think, is a very important piece when you look at the IMF. I respect the IMF. I think they go through a lot of work to kind of come up with these estimates. And we'll obviously sit here and poke fun at it or look at it differently. But again, just to understand that it is hard work that they do, but I don't know where they're coming up with their world number. I think it's interesting that Russia's going to achieve growth given what continues to transpire. And again, I'm not saying that the caps are going to work, because we've already highlighted how they won't. But it doesn't mean that Russia is not going to have to sell things at a steep discount. So there's a lot of different pieces that are rolling down that river. And when you look at, they still expect growth, but again, as you can see on the world side, it's slowing, but versus 22. We just think that it's going to slow much harder and much further than what they're outlining, because our view is that the recession is it's gonna happen. It's here, but it's not going to be like, oh, we have one quarter of minus 15%. It's going to be a continuous, minus 0.5, minus 1%, because we're just going to be bumping along the bottom with very little and realistically no growth and very little expansion, which is going to culminate and add up into a much bigger issue. Now, one of the key things that we want to look at is China, because remember, this is based on this is different surveys. So composite PMI obviously jumped to 52.9, back to expansion following the shutdown and the lockdowns, but manufacturing PMI, again, slight expansion, 50.1, and it makes sense because manufacturing didn't shutter the same way non-manufacturing did. There were still exports happening. There was still some activity, but it's not what's going to be needed to make up for the loss on the real estate side, on the export side, on the lack of consumer spending. So non-manufacturing had that nice pop, but as we've shown on the econ show, you normally get a pop and a pretty hard fade. And it's going to be important to watch how that happens, especially when you look at, industrial profits obviously came in negative. But the Caxton actually underwhelmed and showed some contraction. So if you look at Caxton coming in at 49.2, just below estimates of 49.8, you're getting like manufacturing PMI 50.1, Caxton manufacturing PMI 49.2. That's not something that is telling you there is this massive expansion and manufacturing boom. It's like, it's just kind of bumping along the bottom. And then same with services. Services was expected at 51, came in at 52.9. Great bump, but not as high as non-manufacturing PMI. And you're looking at this kind of tale of two cities. And as we've talked about, new orders did not improve. Let me correct myself. It improved, but it wasn't an expansion. And that's where it's not contracting as much. And that new orders component is showing you the issues that we're seeing permeating on the export side. It's just other countries are slowing, therefore other things are going to be a problem. While the headline numbers look good, the underlying data pointed to some weakness. The zero COVID policy is behind us, but slowing global demand will weigh on manufacturers, especially private firms that make up the bulk of China's small and medium-sized exporters. Base effects alone mean that China will see some solid growth in 2023, but not all sectors will benefit. And that's some of the key things that we look at when we're weighing all these different components. Now, as we shift into the U.S., it's important to look at the U.S. average hourly earnings increased 4.4% year on year in January, the slowest growth rate since August 2021. This is the 22nd consecutive month where inflation outpaced the growth in wages, a decline in prosperity for the American worker, and the primary reason why the Fed will hike again. And I think that's really important when you look at where hikes are going and why we're going to stay there. Home-based data pointed to a huge increase in payrolls. But when you look at where some of the things are, it's tough because January is always tricky. You have a lot of seasonal swings, a lot of these different movements. So there's small percent errors, big absolute errors. There's going to be this range that we have to look at in terms of where we are. But the labor cost pressure is, will it subside anytime soon with job openings at these levels? And that's when you start looking at the jobs numbers. And again, even if you discount this back, it was still a solid jobs report. You still have job openings. You still have a problem when you look at inflation. And then we're going to show you where services are, which, remember, is the sticky part of inflation. It's going to be a problem going forward when we're looking at some of these things and how they're remaining elevated over this time period. So this is a lot of data. We're not going to walk through all of it. We'll wait for next week to do that. But the Dallas Fed manufacturing slightly better than estimates, but still negative. You look at Core Logic for home prices, they came down, but still elevated, and they're going to continue to come down. But they have to. It has to happen at a faster pace, because if you consider wages coming down and home prices staying elevated, and we've shown this chart a million times, there's this massive alligator mouth in terms of, but now wages are turning down. And home prices are rolling, but there has to be an acceleration to push that further. So Minnesota, Chicago PMI of 45, coming in at 44.3. Another negative, consumer confidence coming in a bit light. And then when we start looking at ISM manufacturing, so construction spending came in negative. ISM manufacturing, worse than expectations at 47.4. Prices paid bounced off of what was expected to be a low. New orders falling again to 42.5. So again, none of that shows a positive for manufacturing, with some softness on inflation with prices paid, even though it was well above expectations, still contracting. So that's a good thing. But remember, manufacturing is flexible. Services, on the other hand, had a sizable bump. The Fed did what we expected. We expect to get to 5% at the next meeting. And then when we start looking at the jobs numbers, that's what we were talking about, with some of the data being fairly strong. Now, when we look at durable goods, coming in, durable orders coming in fairly stable. But the change in payroll, that's what we were talking about in terms of some of that shock to the upside. But average hourly earnings, again, falling. And again, it was slightly better than expectations, but down from the previous month. And then when you look at the ISM services, was expected to be at 50.5, came in at 55.2. So now when we start looking at this, it's like, all right, well, that's a big bump, but prices paid actually accelerated again to 67.8. New orders, big bounce, a positive in terms of what's activity to come, but the prices are going back up. So you had gasoline go up and diesel go up in January. Now we're seeing that prices paid went back up in January on the services side. There's on the flexible front and now the sticky front. Again, a lot of this stickiness and holding in that stagflationary backdrop because of these inflationary pressures. This just kind of puts it into perspective on that sizable bounce. Do we think it comes back down? Yes. Does it stay in expansion? I'm going to say it does, and that's going to be a nice little backdrop for the GDP because this is going to be a big component of it. But the manufacturing side is showing a bigger pressure, and it's always the tale of two cities of which side is going to matter the most. It was the service reading a bit overstated and the manufacturing reading a bit overstated, and they meet somewhere in the middle. But regardless, it's still going to net to some form of contraction, but services is going to be the biggest driver of how quickly do we spiral. And based on that number, it's going to be, again, a nice little bump that is going to be important to watch because it also breaks from the regional Fed data. And again, there can be anomalies month to month. The question is direction. And we saw some numbers getting better regionally, but still not expanding. So that's why we do think that there's going to be a little bit of that overhang when we look at what's to come. So now when we start looking at the disconnect, there's a big gap forming between ISM new orders, which has plunged into contraction, and the S&P 500, which has rallied. When you look at the setup, there are periods where they obviously can move separate, but they always catch up. And the question is, which direction does it catch up? And typically new orders are going to drive other things, which is why when we look back to the IMF, they show expansion this year versus last year in emerging market economies on a GDP level. And this kind of flies in the face of that because if new orders are going down, raw materials aren't being purchased, semi-finished goods aren't being purchased. And that's a bigger issue when you look at the inherent supply chain, which is why we have the concerns that we have going forward. Then there's the spread between ISM manufacturing orders and employment, the lowest and most negative since June of 1980. So again, there's the employment side continues to be the conundrum. Now, participation rate did improve, still well below pre-COVID levels, but improving. So does that start to take some of the wind out of the sails on the jolt side? Some of those openings start to close. But this is going to be an interesting one to watch because, again, we're going back to 1980. You're going back to a period where they were trying to get in front of a wage price spiral. Is this showing that a wage price spiral is going to come unless the Fed continues to get more aggressive, which is why we do think that that aggressive move is still there. Household survey moved up in January, which was the strongest gain since January of 2022. And remember, the household survey, there was a big disconnect in the household survey is actually moving closer to the non-farm payrolls, which is going to be interesting to see how this plays out in February because obviously January has a lot of that seasonality and we want to try to sift through what is real. Then when you look at January average hourly earnings, you get an idea of that drop that we were talking about. The uptick in job cut announcements still at odds with the move lower in initial jobless claims, which is that disconnect. And we think really there's a lot of severance packages that are being given out. There's a lot of some of this disconnect, which can happen in short spurts. The question is, where does that makeup really come to pass? So then when we look at the core factory orders of growth continues to slow with year-on-year rate down to 4%. Still healthy, but well off peak of 20.7%, and now slowest since February of 2021. So again, that core side is slowing, with December factory orders coming in at 1.8% versus the estimate of 2.8%. So still getting some of that lumpiness, but again, the trend is moving down. So all of this is really pointing to some of those headwinds that we were talking about on diesel, on distillate demand, and really how that's going to play out in terms of global economic growth, which we still think is going to continue to come under pressure, and we are going to slip into that recession. So that's what we have for you today. I apologize for this coming out late. Coming back from a sickness, while trying to do everything, everything backs up. So we hope you have a great weekend and everyone stays healthy, avoiding the sicknesses that are bouncing around out there. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.